Good afternoon, everyone. Well, welcome to the first panel session of this afternoon. We have many more to go today. We'll be talking about the digital finance, fintech, how it impacted the financial industry, and how it changed the way we live, work, learn, and play. I just came across information this morning, my triggered conversations that we have here. Why the KPMG report just recently launched. Do you know that in the first quarter of this year, the first quarter of 2017, the global investment in fintech company actually hit $3.2 billion US. And that was only the first quarter alone of this year. And we're talking about 260 deals around the globe. And most likely it's clustered in the United States, Singapore, Asia on the other hand. The first quarter of this year, investment of fintech company in Asia is about $492 million US. Well, by the growth rate and everything, it's been pretty promising. And today we have four renowned speakers going to share their idea and their experience dealing with the change and the disruptions, and also with the right incentives on the changing financial industry. Allow me for the first round for the panelists to introduce, you said what you do, your titles is already up there, but it would be great the audience to get to know, what you do and how you actually engage and involve in digital finance or fintech industry.
Okay, so as you heard, I'm Matt Gamser, and I work for the International Finance Corporation, which is the private sector arm of the World Bank. And up until a few years ago, I was a conventional IFC person, and I was working in the financial sector. So that meant we were both directly investing in financial institutions around the world, everything from banks to non-bank finance companies, insurance companies, microfinance companies. But we also worked on the improvement of the infrastructure of the financial markets, including with many of the members of BIIA in helping improve credit information infrastructure in many countries. And I used to be based in Hong Kong, so this was my region, so I was involved here. In the last few years, I was asked by IFC to take on a job for the G20 countries in running the SME Finance Forum. So unlike IFC, which is a financial organization, the SME Finance Forum, I guess you could say like BIIA, is a knowledge organization. And our goal is to improve the finance industry's capacity to serve this very important market through encouraging peer learning and networking and a good dialogue with the high-level policymakers and regulators. And we do that through a new membership of banks and fintech companies and development banks, now 140 or so strong from 55 countries.
Okay, so my name is Thakon Biapant. I'm actually the chairman of Karndee Consumer and also the head of the digital banking and innovation. If some of you do not know Karndee, we're actually the 5th largest bank, but our parent company is the MUFG, which is one of the largest banking in the world. And I also running what we call Karndee Finnovate, which is the newly set up corporate venture capital. So some of you who would like to understand the fintechs work of collaboration in Thailand, so you can ask me on, and also I can share something on this one. Okay.
Good afternoon. My name is Melanie Zimmerman. I am a Senior Vice President at TransUnion. I lead the product development function for our international markets. And so I'm really looking forward to the conversation today and honored to be part of this panel. As TransUnion, one of the areas that we have focused on really over the last 3 years is how we have transformed our business and our identity from a traditional credit bureau to a risk solutions provider. And I was struck by some of the conversations and presentations this morning, which really challenged the credit bureau industry and the data industry more at large around how are we providing value in a different way today to our customers, whether those be banks or the fintechs. And I think this is an area where we have really made a concerted effort. We are the single largest provider to fintechs in the United States, and the way that we've been able to do that and build these relationships so successfully has been by changing the way that we operate, changing the way that we look at the value that we can bring to these organizations. And so I look forward to discussing that more today. Thank you.
Hi, my name is Karndee Leopairote. My role as far as today is concerned is chairman of the Thai Fintech Association, which was an association that was formed in July last year. Prior to that, I still am a politician in waiting, I guess. And prior to that, I was in finance for about 20 years, mostly working on the capital market side. Now, the Thai Fintech Association was formed principally so that the fintech community here in Thailand could have a focal point whereby we could work with incumbent financial institutions and also work with the relevant regulators, the central bank, the agency, the insurance commission, in order to help, I guess, sort out appropriate laws and regulations so as to allow fintech to have the space that it needs in order to develop and grow. Our mission statement is pretty simple and straightforward. We seek basically to help improve access to finance for the Thai general public. We help to reduce financial costs to both the members of the public, but also to corporates, especially SMEs. We set out to help promote Thai fintech so that they can compete not just here in Thailand, also in the region, and in the future, perhaps also globally. So that's my role with the Fintech Association.
Awesome. Now we know, who they are, what they have been doing, and then we're going to dive into the thought and the vision in terms of fintech and the digital finance towards the future. Audience, may I remind you once again, feel free to ask the questions or raise your hands if you need any clarification right on the spot. We welcome that they can ask right away, in a sense that it could help my job much easier. Well, we'll start out with this fintech. When I talk to fintech startups, or a lot of people would like to get into the fintech idea, the number one passion, they would like to help those that, those unbanked people, the one that can't access to the financial institutions. From your experience, could start with God. I think you're smiling at me.
I always smile at you.
All right. Thank you. All right. From your experience, what exactly that they're doing? So has that passion been towards what they want to do, or they've been swallowed by the big bank or the financial institution itself?
Actually, people talk about the unbanked, but if you look at the Thai fintech that exists, most or very few actually were formed to help serve the unbanked. Most have as their primary targets people who are actually currently served by banks, but perhaps served somewhat expensively, and maybe not as efficiently as can be. So that will differ from country to country. You see that the fintech communities in our immediate neighboring countries will more likely be served in that bank simply because the banking community is less developed than it is here, so they can leapfrog that process.
Although it depends which neighbors. I mean, I would argue in my old home of Hong Kong and in Singapore, like you said, in Thailand, the bulk of fintechs are not targeting the unserved. They're doing things like robo-investment advice, and that's where the big investment money is, and that's certainly true of Europe and North America. So I think fintech has gigantic potential for financial inclusion, but it would be a gross misstatement to say that the vast majority of the fintech community is concentrated in that
banks. Over 40% of them are going to the near prime and super prime segment. So it is very much going after, especially coming out of the recession and the financial crisis and the ill will that a lot of the consumer population felt towards the banking industry. The fintechs really jumped on that as an opportunity to go after that segment, provide a much better customer experience, and create unique value in that way.
But the one bit of good news since we've been debunking some things about fintech is that the Cleveland Fed study that showed that you were basically refinancing relatively high credit score people with the consumer credit. In the SME space, that same study found that the SMEs were likely declines with banks that were being served by the alternative lenders. So in my space, the small and medium enterprise, even in the rich countries, whether we're talking about the US with the likes of Circle Up and Cabbage and OnDeck and others, or we're talking about Europe with Funding Circle and some of the others, they do seem to be broadening the market, which is good news on the one hand, but if we put it in the context of the classical service providers for the industry, why are they doing this, and how does that relate to your future business opportunity?
Yeah, I mean, I think that's consistent here with Thailand also. I'm involved with a small fintech company that helps people with refinancing their mortgages. And what we found is that 80% at least of those who come through us have loans of only about 2 million baht. So that's really very much first entry homes. Not the 10 million, 20 million or more expensive condominiums that we see around here. Actually, around here would be about 100 million. So I think that's testimony to the fact that these people, the wealthier individuals, don't need our help because they're already getting well served by banks, offering good deals by the existing banks. But those lower down the food chain, as it were, perhaps can find better offers through access through fintech, and that's what we're finding here. Certainly on the investment side, that's very true because the existing brokerage structure is such that they're only able to serve big customers with large portfolios. If you have savings down to 1,000 baht a month, there's no way that the existing brokerage companies can provide you with any kind of service. So with robo-advisory, as you mentioned, all of a sudden it is possible for them to access the capital markets, and that is what's happening. Which is ironic talking about this on the 19th of October, which people of my generation in the capital markets would never remember this, forget this day 30 years ago.
30 years ago.
30 years ago, that Monday, today. And yet, a lot has changed, and yet a lot hasn't. I was a fund manager at that time, working in London, and we were all struggling to beat the index. Fund managers today still continue to struggle to beat the index, which is why there's that space that's created in terms of just inefficiency or inability for us to perform our duty for our customers of managing their money and beating whatever the stock market index might be. And that's why there is space for fintech, in this particular case, for AI, for robot managers to take our place.
Let's hear from the bank, Mr. Thakon. You're very active. I have to say, Krungsri is one of the active banks around here that get engaged, involved with startups. What do you see from them?
I share my view like this. As a bank, bank has a lot of challenges. How many of you from bank? Sorry, please raise your hands.
Raise your hands. Don't be shy.
Okay. Come up here and help me. Okay. We've been attacked. Okay.
You have no options here.
Bank has a lot of challenges. It's not because of the landscape change or the upcoming of the startup, the fintechs, but the problem is that the change that happens on every aspect, consumer behavior change, the landscape of the competition to change, the technology to change. The problem is that we cannot to change that quick. Okay, and we can mention about the opportunity of investment that fintech can just be part of the solutions. I address like the bank has the few areas that I would call weakness, but don't quote me. This is my personal view. The 4 weakness is one: payment, lending, wealth management, and money transfer.
Would that be everything the banks do?
Exactly.
That's exactly all the banks do.
That's all of the activity that the bank is having a problems. So that's why you see when the fintechs or startup want to tap into, these 4 areas is big enough already to attack the bank before they go and help their societies or helping the financial inclusion. Because these are the areas where the bank has no efficiency at all. So that's why you see a lot of startup and fintech attack payment first, okay? And then lending will be next, but fortunately, the regulation in Thailand has protected the bank and lending. The reason is that because we have the experience of the last crisis whatsoever first. So that's why during that time until now, the regulation has protected the financial industry, in particular of the bank. That's why, unlike in China, if you want to do this, the regulator hasn't had anything yet. So that's why they said, you didn't say it, I can do it. And plus, for example, in China, bank is not there in those outskirts of the city. So the fintech can start easily. But unlike the environment of the bank. So 4 areas: lending, payment, wealth management, and money transfer. These are the areas I think see opportunity that the fintech can collaborate with banks, not go against each other. It's actually collaborate.
Yeah, I think that when I came back to Washington and I started this work a few years ago, everybody was talking. Jamie Dimon had just said the fintechs are coming and they're going to eat our lunch. But we could see already then that the greater potential lies in partnership, and we are increasingly seeing that because there are disadvantages and advantages on both sides. And I don't want to seem like I'm bashing banks because the largest group of my membership are banks. So, but you know, we've developed a pattern in banking. It's led by the Western banks. I'm sorry to say that the bigger the bank, the more the model is based on less than 5% of your clients and your branches subsidizing the rest. And this is really bad for emerging markets where you don't have most people in the financial system at all, right? So if you have this model that can't make money off the base of the pyramid, and you have an environment where people don't have accounts, then what do you do? And the reason was that it depended on either a very personalized approach for corporate banking or a very automated approach for consumer banking, which up until recently was hard to do in emerging markets because you didn't have the automated data. And the good news is that fintech can get around this in partnership with banks, because fintech can help accelerate a transformation to a new model where you can make better use of the increasing quantities of data that's available, we've been talking about all day, and you can find, instead of finding this client group too expensive to acquire and too expensive to serve, they can become not only affordable but competitive with your other asset classes. And as you say, you know, payments are where fintechs have gone first, but they are actually one of the keys, because the degree to which you can make this movement depends on the degree to which your consumers and your small businesses are moving from cash transactions to electronic transactions of any form. The more in your country that movement is happening, the greater the potential to turn what's been a subsidized asset class into a profitable asset class.
Yeah, I can see, I understand your example, the top 5%. Depends on who the top 5% is. Quite often the way the lending market works here in Thailand is that the biggest customers are not the most profitable customers, or rather the strongest corporates, very fine margins from banks. And in fact, in many ways, it's the SMEs with little bargaining power, they're the one paying high rates of interest and providing the profits for the banks. So in the context of Thailand, fintech, there's a sort of a space for them, pain point, if I use that term, at the lower end of the market, where the spreads are high, and quite often perhaps higher than the appropriate risk profile of these models. And that's why the first target for fintech is at that level. Fintech is not trying to provide a service to the top 50 listed on the stock exchange of Thailand. They're trying to provide a service to those who are not listed at all and paying very high price for access to loans. But as Khun Thakon pointed out correctly, I guess the biggest potential for fintech in Thailand hasn't yet opened up, and that is B2B lending, or even B2B lending in a way that disintermediates the banks. Thakon mentioned experience of 1997, our financial crisis, as a reason why regulators may be reluctant. I'm not so sure that that would be the right rationale, because having lived through 1997, I think a lot of the reason why we got in trouble was because banks were the ones that were making inefficient allocation of loans. So in a way, concentration of money, which is the major role for banks, proved to be a reason for the downfall in the financial system. So arguably, if you spread out that role, you might actually be allocating the risk, including spread across a broader portfolio, which might be safer for the system as a whole.
Certainly, that's the way we look at it in the IFC side. In our broader emerging market experience, what has changed in recent years is it used to be that the banks had two markets. And the bigger the bank, the more these were your two real important markets. One was lending to governments, which were guaranteed to repay and were not managing their finances well, so the rates they were paying were quite high. So that was easy business. And the second business was that you could lend to corporates, because at the time, pre-financial crisis, your market was often protected, and you didn't have the international banking community coming in and lowering the margins as you describe it now. So why should you care about SMEs and consumers? You could take these two easy markets and go play golf at 2 o'clock, and on the golf course, maybe you divided up those two markets among yourselves in ways that we shouldn't do in competitive markets. But today, the good news is that, as you say, the corporate market is thin, so there's incentive to look for how you could serve this. Governments have their financial act relatively in order, so they're paying less. So there are positive forces, but the practices that develop, that was my point, have made bankers kind of ill-suited unless they're willing to reinvent their approaches. And the opportunity of a partnership with fintechs is you can bring in refreshment, if you will, of the way you approach these markets, how you can transform the customer experience and the allocation of human and financial resources. And it's not easy, right? There's a lot of talk about these new partnerships, but they're still in the early teething stages. JP Morgan Chase and OnDeck, Cabbage and BIIA, Cabbage and Royal Bank of Scotland. There are a bunch of other things happening, but people are learning to work together. It's like early stages of a new relationship.
Talk about relationship. I know that lots of folks here are from the information industries and also the credit bureaus. I'd like to direct to Melanie. Fintechs, has a rise, and we have a huge investment right there. What are the emerging relationships between the credit bureaus, just like TransUnion, with the fintech startups? What can you give us an example, or how we can coexist together and make the whole ecosystem worthwhile and more transparent?
So, as I mentioned in my opening comments, TransUnion has been very successful in the United States. States in establishing very strong partnerships with the fintechs. And we are, the leading provider of credit data and solutions to the major fintechs in the United States. And we didn't get there in kind of a straight path. We made some mistakes along the way. And the first mistake that we made is when the fintech market started to emerge, our initial reaction was to service the fintechs in the same way that we always service the banks. And we quickly found out that wasn't going to work. And very simple things, as an example, our membership process, again, any of you that are in the information industry can probably relate to this, had a step in it that said, you had to fax a copy of an agreement to us in order to complete, step 22 of the membership process. And the fintechs kind of laughed at us and said, fax machines, like, who uses fax machines anymore? And so we had to kind of go back and say, not only the fax machine, but the fact that the process had 22 steps in it was a problem and was frustrating to the fintechs. And so it sounds like an easy thing or a silly thing to change a process, but when you think about becoming a member of the Bureau, that's a big deal, and there are lots of checks and balances that are required. And so it did require an acknowledgement and a willingness, not only from our product and our vertical and those teams, but also our legal and compliance departments to say, how can we create a more expedited process? How can we make ourselves easier to do business with? Because that's the expectation coming from the fintechs. And so that's a very small example, but beyond that, some of the things that we have learned and that we've shifted, which not only benefits the fintechs, but ultimately allows us to serve our banking customers better, are things like an innovation lab. And I remember from the earlier panel, one of the gentlemen mentioned innovation labs being a big part of their business now. And this has become a very critical point, because if you think about the management teams of these fintechs, in a lot of cases it's a very small management team. They have high pressure to deliver real results and revenue in a very short period of time. It's getting certainly better now, but in the early days, a lot of times the management teams had limited credit risk management experience, which is a critical thing as you think about lending into these markets. And so then we saw an opportunity as TransUnion to service these management teams in a way that we became a consultant and a partner working side by side with them to really enable them to get access to our information in an innovation lab type of environment where we could ask questions of the data, help them identify target markets that they could pursue, understand the risk profile of those markets as they entered into them. And that level of engagement and that ability to come in and bring them into the office in Chicago, sit down with a question and just hammer it out, for 48 hours straight in a room, and come out with a decision and with a result that they can then act upon, was very, very powerful. And the feedback that we have heard from our fintech customers is that has been an invaluable kind of experience, and an experience that they've received only from TransUnion. And so I think the way that you can think differently about your business and how you engage with your customers and the value that you're ultimately bringing. If you're not coming to the conversation with a piece of information that your customer doesn't know, then why are you there, and why should they give you that time? And I think that's become kind of a fundamental premise of how we engage and work with the fintechs. I think the other point from this morning around data is a critical one, and I think the fintechs have certainly challenged us to think more broadly about the data that we bring into the market and that we make available. I think my colleague from CRIF said it very eloquently earlier, this hasn't been a situation of newcomers taking out incumbents. It hasn't only been that type of situation. It's also about the cooperation and how can we look at the data that we have, the other data that's available in the third-party markets, the data that the fintechs or e-commerce platforms may have, and how can we really bring that together to drive more insights and more value for them. So thinking more broadly about data and the role that we can play, having a much more consultative approach, and also re-looking at our own processes to be more agile, more nimble, faster turnaround time has been critical.
This is a real, I found this morning very encouraging, and I find this example from TransUnion also encouraging, because look, in the larger sense, all of you are fintechs, right? You're technology companies that have been in the finance industry for a while. We just didn't have the term before. But, as we heard this morning, that's not, these new guys, who are a very broad group, right? Alibaba is not the same as Cabbage is not the same as Funding Circle. There are lots of differences here, but just because you've been around for a long time is no reason you stay around. And I like that you're willing to have an opening session that says, hey, we could be dead in the water because all this data that's not in our control is in the control of very powerful forces who want to do our business. Great. But at the same time, how can we, if you then take that and say, oh, well, we're not just going to run and hide, we're thinking about how we too, it's not just banks that partner with the new fintechs, we also have to figure out how can we make new institutional relationships, how can we go forward and do more, and what is our core skill in doing that? And I would argue that you need to, the message I took away from this morning is the idea that your comparative advantage is your ability to aggregate data is not your comparative advantage for the future. It's your analytic skills. That is where your core skills that cannot be disrupted by the new people. But that requires, just like I've heard Visa and MasterCard tell me, we're not a card company, we're a technology company. The same is true of a business information company. You're not an aggregator, you're an information company. And in that vision, there's all sorts of possibilities for survival. But as an aggregator, no, I'm sorry. Alibaba, Yahoo, sorry, not Yahoo. They already got eaten by Alibaba. Alibaba, Google, Amazon, Facebook with 70 million small business data they got for free. These people are going to eat your lunch. But there's a bright future in the other way of looking at things.
I think Mr. Joe has questions. Can you have the microphone? And you can have mine.
We need a microphone, Wendy.
Thank you very much. At the B20 discussion in Hamburg in May, the German Chancellor, the president of the G20 that year, suggested that regulation was too high for the banking industry, which allowed the fintechs, or ultimate finance, as you call it, to eat their lunch. And there was a suggestion to bring down banking regulation so that the banks could be more competitive. The result was that in a following panel discussion, in which the German finance minister and the banking industry and the Minister of Digitization and Finance participated, the banker said, we are not worried about fintech. We're worried about Silicon Valley. It's the Amazons, the Alibabas, the Facebook, all these guys, they're going to eat our lunch. What's the situation here?
Can I share first?
Yes.
Yes, as a banker, we're not worried about the Silicon Valley at all. We're more worried about the Ant Financials, JD.com, and others. Because you already see that the JD.com partnered with Central to set up the new JV. That's a big move. The Ant Financial has already partnered with one of the telecom company here, True, to set up the AdSense, start doing a lot of payment, and perhaps they're going to go with the lendings if the regulation is open for the peer-to-peer lendings. So those, I think it's a different, it's the same animal, but come from a different continent, which is more closer than this one.
And remember that Amazon's in Seattle, right? So it's not about Silicon Valley, it's about the internet giants. That's the right way. In the paper that we did for the G20 on alternative data and how it's transforming the world of finance, we did not use a term like Silicon Valley because it's definitely not a Western threat. It's a global threat from the companies that are mastering the internet and acquiring control over massive quantities of data about day-to-day transactions, and not just financial transactions, as was discussed this morning. And maybe that legal decision about crawling LinkedIn is going to lead to a decoupling of these guys' assets from their control, but I wouldn't depend on that in the short term. I think in the meanwhile, you have to figure out how to work in this space and how to create useful add-ons to believes that you don't get, I mean, it's not, again, it's not just banks that are threatened by this, it's if anything, more you guys, because they're doing their own internal analytics based on a large quantity of data, and they're hiring some of your best people, by the way, and they're bringing them inside and paying them more money because they have economies of scale from the other sources of revenue. So that, it's the figuring out how to deal with that, but at the same time, you have that, just like banks and the information industry have a history of trust. I know there's been some glitches of late, but you do have a long history of trust. You do have a long history of familiarity with how finance works in a regulated, safe environment. How do you build on that to continue a competitive advantage? Because this is not there's no reason that this should all take over.
And one thing is, if most of you guys come from the information and technology companies, come and help us. Because we actually want to open and have some sort of the technology to help us. When Karndee mentioned about the financial inclusion, the fintech can actually help. Payment is one thing, but actually lending is the big chunks of the opportunity. I myself running the largest credit card and personal loan in Thailand. I also the chairman of the Thai Fintech Association. I also run the microfinance and also the nano finance. And in Thailand, we also even have the pico finance. You know how small it you want to go. I still have to ride a bicycle with my team to go to the noodle shops, waiting for our countings, how many noodle bowls that they sold, even interviews, how much they spend to buy the raw material, this and that. Because all these shops, they're not doing any record at all. And the transaction was based on cash.
You know, this morning when the idea was launched of creating a blockchain for the files that you now have in separate concentrated databases, so instead having a decentralized system, I thought, well, nah, I don't agree with that, was my initial reaction, because it's still not going to be as big as Alibaba's massive data or Google's, and you guys will never cooperate to do it. But the more I think about it, the more I think there's something to this, that it's kind of like a Visa moment from the era of First National City Bank being the only bank with a plastic card for the general masses. And they decided to open that technology and let all of their fellow bankers come in and create a larger pool, because in the short run it hurt, but in the long run everybody did better. So the more I think about that idea that our keynote speaker launched this morning, the more it may be one of the things that you could do, because collectively you could create a new infrastructure, a global infrastructure, a more efficient infrastructure, a less corruptible and hackable infrastructure, which then, because you've been a part of the creation, you would have an advantage in how you use it and how you build, as opposed to, well, we have our way of aggregating and our data set, and my competitor in the information industry has theirs, and if you stay in that, you could be lunching.
Following up to Kun Joe's questions on the bank, actually should not be afraid of the fintech, but rather that those big guys in Silicon Valley, with Facebook, Google's, or things like that. Kun Karndee, you made the comments earlier before we entered the rooms that we actually have a Thai Fintech as of now, that they use a social profile to determine the credit lines or anything like that. Can you share to the audience? Because it's something that not just the bank is being threatened by the fintech, but we talk about the credit bureaus or how we use the information itself.
Yeah, just a startup that is talking about analyzing credit based upon what you post on Instagram, which sounds kind of funny when you first hear about it. But as they talk a little bit more about it, it does make some sense. I mean, you having meals in expensive restaurants and you're posting dishes from these restaurants, it might say something about your income, or even if you're not paying for these meals yourself, at least you have rich friends. So there's all kinds of different interpretations of the mass of data that's out there. This is what we're saying. And in a way, assess credit. Nobody else was doing that. But now, with the amount of data that is available, arguably they're no longer the best at analyzing credit. And that is a problem. So I think the challenge for the banks, therefore, is how to get into that data mining game, and how can they possibly catch up, given that they don't have access to the same level or same amount of data that the e-commerce platforms do, for example. The other challenge is actually just capital. Capital results, given the valuations of some of these internet or tech giants, are so big that they can afford to take the kind of risks that banks cannot, and afford to take hits that banks cannot afford to take, not least because they're not regulated in the same way. And I think that comes back to Joe's point about uneven regulation. And these are some very tricky challenges. From FinTech's perspective, I think we feel just as threatened, if not more so, than banks, with the arrival of these giants. Simply because no individual FinTech startup, let alone Thailand, but even in bigger economies, could possibly compete with the kind of resources that these giants bring to the game. So the mentality of a lot of startups is to build a name and scale, possibly so that it could be eventually acquired, as some already are, by these giant tech companies when they finally do arrive in our market. I think it would change everything. If you look at Alibaba, if you look at Tencent and WeChat, they already serve the 10 million or so Chinese tourists that come to Thailand. I think 10 years ago, 5 years ago even, the Thai banks would be enjoying the benefits of foreign exchange transactions, not least, and payments also, as a result of the shopping that takes place, that these tourists do in the country. But now, they're being bypassed altogether. And so, it's a next easy step for these tech companies to take from simply serving their existing customers from China who travel to Thailand to servicing Thais themselves. And big challenge for the regulators too, as to how to approach regulating the banking activities of these offshore tech companies.
I wasn't in Hamburg, and I'm not speaking on behalf of the World Bank Group. This is my personal opinion, but I was with Chancellor Schäuble in March, and when we had a G20 meeting on locally active financial institutions and how they might be treated differently. And at that time, he didn't make a broad statement that we're regulating banks too hard. His statement was something that I can agree with, because he said if we're talking about locally active banks, as opposed to banks that are both globally active and ones that are integrated with investment banks and insurance companies and other things, then one size fits all does not make sense. And I completely agree with that statement. But, but I think anybody who's lived through 2008 should not just blanket agree that banks are, maybe there is a little bit of overreach, but the overreach is more about the domestic banking activities and how there's unintended consequences of some of the things that have happened in the Basel process and in the risk weighting of assets. And where your industry can be a real contributor here is that you are in the best position because of your history to understand where risk really lies and what makes risk. And let me give one example. So, according to Basel people, I'm going to really overgeneralize here, a small business that has audited accounts and a formal business plan is a lower risk than a business that doesn't. Now, I hope none of you in this room agree with that statement, because I've never found that to have any correspondence to the behavior of a loan. There are a lot of other factors that do, especially cash flows and customer relationships and things that relate to the business activity. But these old documents are not. But yet that sort of thing is being broadly applied to how banks should set aside capital. And so banks that are serving local markets are having to reserve scarce capital at a time when we want them to lend to small business, we want them to lend to their local markets, but they're being starved of capital. So that's where you know better, because you're doing the analytics, and you know what really correlates with risk and what really correlates with losses given default. And it's a good opportunity that we can correct, but whether we should loose the leash to the very biggest banks that nearly blew up the world a few years ago, at least in my personal opinion, I don't think we should necessarily make such a broad statement.
Melanie, we were talking about the way that we use information could be very different from what we had in the past. We have the data, big data, no matter how big it is, but you can't make a patent out of it. It basically is it doesn't make any sense. In terms of credit bureaus, an example that Karndee just mentioned, so the way we look at, like a scoring, the credit and everything, could be very different from the past. From TransUnion, what is your comments about that?
So I have a few comments on that, surprisingly. I think first I'll just build on the point that was being made around this Instagram kind of fintech startup. And I think when you think about what these types of companies are trying to do, whether it's this Thai company, it's a company like Lendo or EFL, or there's several companies that are looking at this social data. Ultimately, what they're trying to identify or create a picture of is the character of the person. Right? So when we think about lending and making lending choices, predominantly we're looking at two things. One is the capacity of the consumer to repay the loan or the debt. And second is the character of that consumer and ultimately their willingness to repay, whether they have the capacity or not. And so if you think back to kind of the origins of lending, I was not around for that, but ultimately, banks were predominantly transacting and working with individuals that lived in that village, right? And they knew their families, they knew friends, they knew where they worked. As we now move into a faceless environment where it is fintechs and there is no branch to walk into, as an example, there's a loss of that ability to really look someone in the eye and understand more about their character. And I think that's a critical piece of the puzzle as we move into this next kind of phase from an information perspective is, how can we as credit bureau providers not kind of diminish the value of that information, but actually embrace the fact that this provides another piece of the puzzle, another set of information that can help organizations make a better decision. I think in terms of the core credit data, we also have to kind of challenge conventional thinking about what a core or a traditional credit report is. And this is something that we've spent a lot of time doing over the last, I'd say probably 5 to 7 years, is really looking at the credit information and challenging the status quo, which was that a credit report, when you pulled it, was typically provided you with a point in time view, right? So you could see for Melanie, how is she paying, how is she paid on her accounts, but there was limited information that you could actually look at historically. So as an example, someone that scored a 750 on their credit file, you could have all 5 of us scoring a 750, but we actually represent very different risk profiles. Because I was a 600 and I've now grown to 750. He was at an 800 and that has come down to a 750. But you lost that perspective with a traditional credit file and with still many of the credit reports that are being provided around the world today. And so what we've done as TransUnion is innovated on the credit report and said there's more value that we can actually drive here by bringing historical trended credit information to the forefront and making it available for real-time decisioning. And so what that allows us to do is not only look at whether or not Melanie is paid on time, but look at how much she's paid compared to her minimum payment. So if I'm a continual payer that pays in excess of my minimum payment due, that tells you a whole different story about my risk profile. So I think there is fundamental innovation that exists on the core credit report information and core credit data that is untapped in a lot of markets. financing with a lot of organizations, and if you can really fundamentally rethink the credit file, there's a lot more value that you can bring to the industry.
And this is where, again, your expertise is actually an asset, because we've done a lot of work with alternative data and traditional data, and there's a lot of misinformation here because if people don't understand how you really do assess the performance of a scorecard, which I hope no one in this room has a problem with that, because that's your business day to day. But I'm amazed at what I've seen happen in terms of people's assessment of things. And to start with, we have to recognize that, yes, we had a problem. Many, many people, especially in emerging markets, had no conventional financial footprint. They either didn't have an account with a financial institution or they didn't borrow. So, and that was where we used to do all this stuff. But even before we go to psychometrics and how you and who your friends are on Facebook and things like that, there's a whole new raft of financial transactional data that is now available. And it's not only available, it's available and refreshed in real time, as opposed to the old data, which when we got the latest report on the, from the accountant, or when we got the latest report from the bank, we refreshed things. So there's a whole new raft of data that comes in all the time, and now that we have artificial intelligence and machine learning capacity, we can capture more data and analyze it more frequently than we ever could before. But we still have to understand the principles of how to do that and how to find out what really is significant and what isn't. And that's where you still have your experience. And I've seen that because we, through the G20, have helped support some of these innovative organizations. And one of the ways we've supported them is by bringing some of your more old school knowledge to helping them actually look at what their experience is and how they should evolve their models. So there's a lot more data out there. It can be analyzed more frequently, so you can have dynamic scoring and not just, and that opens up all sorts of new business and service opportunities. And I don't know if anybody read this morning, but I just learned that the DeepMind of Google, the one that beat the 2 world champion Go players, so they've created DeepMind 2, and it apparently beats the first one, but the only thing they did is they gave it the rule book for Go and let it practice playing against itself. There was not all the micro instruction that went into the first one, and yet this machine now beats the old one. So that just shows you what the capacity is if you can harness the power of AI and machine learning for all this.
I think perhaps if I may ask you to tackle on this as a banker, from listening to Melanie and Matt, what we are increasingly able to do is be more dynamic in the way we analyze individual risks. But that's no use if the banking model still requires the peg to fit that round hole. I mean, the square peg is not necessarily a bad peg. It's just not a peg that fits around home. And so we might have an ability to analyze all these individual credits, but unless we can be almost custom-made the credit product to these individuals according to their differences, then the data is not properly used. And I think that's where fintech comes in, really. Perhaps it's partly a result of cost structure that banks can't be as flexible in the way they structure their products, to fit customer needs. But perhaps with fintech, that is something that banks will be able to do.
Let me share my view like this. Everyone can lend the money out, but not everyone can get the money back.
That's true. That's true, yes.
Then when we're talking about the models, we're not talking about the model to lend the money, but the precise model should help us to determine the right ability to get the money back.
Interest.
Okay, but if you're lending the money and the customer has to come to the branch in the old school way and make the payment on a given day, and PayPal's lending the money, and as you heard this morning, as you use PayPal, they're automatically garnishing their share every day through a channel that you need, and yet they control. I'm sorry, the risk is not the same, even if that loan is structured the same way. And so the regulator needs to recognize that new approaches and new analytics can yield different risk weightings. But they'll only do that if the regulator gets RegTech to alongside your FinTech, because they need to use the same technology, because just like we don't want bankers using an overly labor-intensive, inefficient approach, we want the regulator not doing it a human approach. They need to use machines too.
Okay, let me quote like this. We're running the largest personal loan in Thailand. We're running the largest in-house collection in Thailand. We know how to run the personal loans or unsecured. And those, yes, although you guys are talking about the embracing information and technology could help. It could help in such a way that we can lend more. We can lend more to another level that we never able to go there before because the information wasn't there. Once we be able to analyze and able to say that, okay, I can lend you, next phase, if I need to get the money back, the technology will never able to help me. I have to send someone to get the money back. But the point is that right now, with the digital transformation, can help in such a way that the PayPal, Alipay, this and that, because the transaction has moved from what we call analog to the digitized form. And then when it's become a digitized form, it can help look into the fund flow or transaction flow. So that can help lending out quicker. But to get the money back is still not the right model at this point to help us. Why? Because when you lend out the money today, the bad debt is not happened yet. It happens peak loss on the 24-month or 36-month. Because along this way, there's a lot of other incidents that could happen and create the tip over. Why? At the point that we lend, they are good customer. But along the way, there's other incidents that not yet able to predict unless you have and monitors the information along the way. Be it flooding, for example. Unfortunate circumstance, I have to fix my car, fix my house, I need cash automatically. Whatever I used to be paid, I cannot afford to repay at the same amount. I have to become a default, for example. Or school opens. I have my third child, for example, whatever. So all of this not yet has a precise solution yet to help us determine whether or not the ability to pay in the future is still correct according to the credit model that we grant today.
Listening to you and looking back from what we had this morning from the minister, from the digital digitizations, at one point, our country talks about we'd like to go from cash society, hopefully to cash loan society, and hopefully we're going to get into the cashless society, just like many other countries try to drive forward. If it goes in that direction, would that help your job much easier?
I really love these moments in such a way that you guys know how many ATM we have in this country?
Take a guess. 60,000?
Yeah, a little bit more, 50,000 is enough. Okay. And you guess how many money we put in each ATM? In nutshell, we're talking about 200 billion money in ATM.
Around the country.
And in Thailand is the only way that the only country you can see the layouts ATM machine one by one. Maximum that I have seen 9.
Yeah, in the mall. Yeah.
In the shopping mall.
Together.
We'll never see this in any other country before. But the point is that each year people go to ATM to withdraw money. You know how many? 7.7 trillion cash circulating on this one. And people go to ATM to withdraw money for 2 reasons. One, to get cash to pay for goods and services. The other one, to give money to the other person. In Thailand, there's one technology called PalmPay. If you can hear, PalmPay is the transfer money using your mobile across, free, because the government.
As easy as I can give you my mobile phones and you can transfer money to me.
Right.
I can give you cell phone numbers.
And now it has been a lot of discussion and talk about QR payments. The first unified QR code standardization happened first time in the world, yes. And yes, once these two come into the picture, once money can move around, transfer using PalmPay, now make a payment to QR code, there is no reason to go to ATM anymore.
So what do we do with those 50,000 ATMs around the country?
If you guys want something to decorate your house,
You can put your flowers in them. I mean, look, if you go next door to China, you can see what the future might look like. Because you do have an ecosystem. You don't have it in East Africa, despite M-Pesa and everything. You're only making the transfers electronically. All the small ticket payments in the merchants are cash.
we're going to
Just like
resell.
here.
We're going to resell it to Bitcoin because we start to see Bitcoin ATMs.
But my point is that in China, you were making most of your payments through one of three big payment systems, either WeChat Pay or Baidu Pay or Alipay. And if you were borrowing money, it's from those same companies. And you were doing your daily B2B and B2C through those companies. So when you get to that stage, collection is a different story because I cannot risk being ejected from that platform anymore because it's a part of my vital day-to-day business. So one, I'm going to let you take my pay every day, take my share every day. But the second thing is on the benefit side, why should you have to have equal weekly payments or equal daily payments? If you take in less money, you should pay less. And if you take in more money, maybe you can pay back faster. And this is, in this new system, you can enable that. But in the old style bank collection system, it's not something you can do. I know a bank in the Philippines that is already proactively, when a typhoon is coming, ratcheting down. They have a merchant advance system that uses daily collection, and they ratchet down the percentage when they know a typhoon is coming. Why? Give the merchant a bit more cash on hand in case there are unexpected expenses. So all this is changing the risk profile, which is again why we need not statically but dynamically to be assessing, and we need to be educating the regulators about what is possible and what they should be trying to encourage, as opposed to very old school ways of, oh, do they have a mortgage? Do they have cash on deposit in the bank, which may not be the best way to regulate.
All right. Now I know that ATM machine was soon to be a vintage item, something that I should
Don't
collect.
quote me yet.
All right. Something antique in the future. We have 26 minutes and 30 seconds left. I would like to, the open opportunity for the question from the crowd. I'll start with Mr. Joe. Can you speak louder? Or turn it on.
And this morning, somebody mentioned about a certain company, a certain fintech company in Germany that actually is pulling their nose in our information business and saying they don't need it. And recently, the company actually appointed 2 bankers to their board. That signaled to me that the lending is not going too well. And I wonder whether your fintech companies in Thailand have that same experience, whether they are drifting back into bank-regulated lending.
No. Let me have a go. I'm involved with, as I mentioned, a small fintech company here. We recently hired as the CEO a banker, somebody in what we call somebody with domain knowledge. The main reason why that was necessary is because, by and large, we still operate within the existing banking framework in cooperation with banks. Therefore, we need to know, we need our people to understand how banks operate and how bankers think. So in a way, the hiring was dictated to us by the structure of the ecosystem of our business. Now, if there was deregulation or proper deregulation, allowing non-banks to operate in the banking space without banks, that might not be necessary. So what I'm saying is I think, I'm not sure about the German example that you just mentioned, but in many instances, when fintech feel they need banking expertise, it's partly because they need expertise, partly because they are still operating within the existing banking framework and they need somebody who understands that system.
I would reflect his question like this. So it means there's a lot of opportunity for me out there to get out of the bank and do something else, which is similar to the quote from my boss as well. He says, Takon, you've been involved with fintech too much. I'm afraid that you will be out of the bank doing your own fintech things. But I think, like Kun Korn just says, I think both sides need help from each other. The bankers know the regulations is how to execute it right. But we want to get involved with fintechs because we want to absorb the technology, the ability to work, the agile ways that doing quick things. When he asked the question, do we afraid of the Silicon Valley, and then the response, they afraid more on the Shenzhen or Beijing technology guy. The technology is one thing, but the speed to be able to executing is amazing, which is honestly, as a bank, we cannot do it. And I do not know whether or not we will have the capability to doing that one, okay?
I'm not the banker, but I'm actually more pro the future for the banks because of something we haven't discussed yet. We're focusing on credit. And whether we're talking consumers or small businesses, they don't have just one mono financial need. And the comparative advantage that remains with the banks is the ability to offer a suite, particularly in the universal banking model, is to offer a suite of products, not just for that customer, but for the family or the employees, and so that, I can't see fintechs coming and doing everything. What we see instead is fintechs are specializing in one or the other. So the banks that are smartest are moving to what is commonly called the open banking or the open API model. And this is just as true of a Wells Fargo, by the way, for all the bad stories you've heard about consumer finance, as it is of a new neobank, right? They're all open and plug in lots of different specialist services, white label them. But in order to bring that off, you need top-notch analytic capability. So again, it comes back to another potential gold mine for the BIIA group, because you not only have to monitor one-off, but you have to monitor in real time to see, because your client's profile changes over time, and you need to get the signaling about, oh, there's a life cycle event, a change. What does it mean in terms of how the cross-sell changes? And making the maximum wallet opportunity is always going to be something that as a regulated bank, you're going to have more ability to do. So if anything, I see that more of the fintechs coming into the banks, as long as the bankers can do what you said, they have to be able to overcome that challenge and be able to execute fast and change the old style way of, oh no, we need 15 committees and look, we have this in IFC just as much as you have it in a commercial bank. We need to get out of this. We can't do anything without 15 committees and 5 feasibility studies. It has to be able to move and evolve because there is so much more possible now because we can capture so much more in real time.
And actually, one opportunity for the banks to embracing the technology is just to invest in those technology companies. Because if we love that technology or love that service, the other customer would love the service too. So this could be the opportunity that we can actually work on growing the business through the investment.
I saw some hand right here earlier. Yes, please. The microphone's right there.
In Thailand, there's a minimum requirement for, in order to qualify a credit card, you need to have 15,000 baht. Okay. Do you think in order to increase financial inclusion among Thais, it would make sense to remove that requirement and offer a credit card to anybody, some sort of disposable income? It doesn't have to be 1.5 times. It can start at 1,000, 2,000 baht, and the customer or the credit card holder can work their way up. And wouldn't that be more politically correct, or even not for that, even if just to give them a chance to build the credit instead of punishing them from day one that, okay, you make less than that, so you never get a credit card unless someday you get a big raise or something. Okay, thank you.
Anyone in this room from Bank of Thailand?
Bank of Thailand,
No, right?
show yourself right now. Okay, seems like no.
Okay. I think it depends, but when you look into the context of the Thai population, which we have around 67 million, the credit card in Thailand is around 20 million or 22 million plastic, and each individual person holding is almost 3 plastic per customer. So in nutshell, from 67 million population, only 6 million actually the individual one. Okay, only less than 10% to reflect you. Whether or not we should relax to open up so the those who actually earn less than 50,000 to be able to have the credit card. It depends when you look at the credit card, you look it as the payment vehicle or you look it at the credit product. If you look at the payment vehicle, yes, definitely, you can go as low as you want. But if you look at the credit product, you have to assess whether or not they have the capability to actually repay it back. With the 15,000 minimum income to reflect, for those who earn 15,000, I would assume if you live in Bangkok or big city, 15,000, no way you can survive. From any research, if you live in Bangkok, you have to earn at least 30,000 baht already, because the cost of living in Bangkok is very high already. So meaning that there's a risk in itself already to give the credit to those those incomes at that level. But it's pro and con. I cannot have the right answer yet, even though I'm the chairman of the credit card clubs. I would love to be able to grow the credit, because the more we have the credit card, we hope that they can use, and then we can turn from the analog transaction to become more digital technology. But on the other aspect, whereas the household debt still at the 80% of the GDP level, and everyone point to credit card and personal loan, that these are the ones that create the big one. So there's still a concern in terms of the the sensitivities in terms of the level of the household debt. Okay, because yes, the easiest you access to this one is also could create the unawareness or an intentional to misuse of those credit facility and become higher debt.
I mean, I don't know the situation in Thailand, but in general, I would advocate moving to electronic payments as opposed to moving to debt products as more of a priority. So having a debit card or having the ability to pay, put things in your wallet on the phone and make payments with what you already have and create a footprint should be more of an immediate priority than trying to throw credit out to poor people. I mean, we've seen in all too many countries where, credit, with all due respect to the Nobel laureate, Dr. Yunus, credit is not a human right. And there are certain people that are credit worthy and certain people that are not. And it's not a good idea just to insist that everybody borrows for the sake of borrowing. But that's why we need data, and we need to see who can handle it. And maybe you take baby steps, like you have prepaid cell phone data, but you have over time companies that then analyze that repayment history, and they give you a $2 effective overdraft on your cell phone, which if you don't pay it back, it's not the end of the world, right? You're not going to lose your house, your kids will still go to school. But you develop some credit discipline that way, as opposed to jumping to lines of credit, credit cards, things that are, it gets more, you need more financial literacy and awareness before you go there. We do see some evidence in countries that do the government payments, where, like Brazil and Mexico, that where they are allowing those to be leveraged into credit, that we're seeing some disturbing signs of consumer over-indebtedness if they're not coupled with appropriate consumer education and financial literacy programs. So we do want to go electronic, but we don't want to, as we accelerate the velocity of transactions, we don't want to get beyond the capability of people to understand what commitments they're making and get them into trouble.
In my earlier careers, we used to give the credit to those who have 5,000 baht income.
Really?
In the past, 5,000, 6,000.
Wow.
But then it's escalated up, and now the credit card is 15,000 by law. But the personal loan is still open, but I think we started with around 10,000 baht as the minimum income.
I was just going to add a slightly different variation on the point, which is a recognition of our role as information providers to really educate the communities in which we serve. And I think as we have built out our credit monitoring and credit education services, we've also found that to be an area of value creation and differentiation in a lot of cases for not only the fintechs, but also our traditional banking customers, as a way to really allow them to kind of put that knowledge, put that information in the hands of the consumer. And you know, there are fintechs like LendUp in the U.S. That do provide ladder loans and are you know, going through a model, or have a model, excuse me, of graduating kind of the credit offerings that they're making available to consumers, and the role that we can play there in consumer education and consumer credit monitoring services is a very important one as well.
And one of the most exciting areas of new fintech growth is in putting on the smartphone platform many of these customer education and value-added services. And for consumers, it's financial literacy, helping understand your accounts and do your budgeting. For small businesses, they even do customer management services, loyalty programs, so you don't have to be a Target or a Walmart, but because you're using a cloud-based system and it's connected to your electronic transactions, the patterns are seen and you can get all sorts of new advice. So this is another great opportunity.
I have a feeling that the development or the entrance of the big tech firms into personal lending may help solve a lot of these problems, because the other angle to the question, and we discussed it at length when there was a parliament, was the issue of interest rates that are charged. A few years ago, the cap was something like 50%. That was reduced because we thought it was too much of a predatory thing. But there was an argument in keeping the cap high, because at least it allowed people to borrow from within the financial system rather than having to go out to loan sharks. So in the Thai context, we have about at least 2 million who are dependent on loan sharks. And that's very dangerous. Not only on the interest rate charge, typically something like 5 or 10% at least a month, which is way, way higher than anything the Thai loan charges these customers. And very aggressive loan retrieval processes too. But I can imagine that, as you say, with Chinese borrowers not wanting to fall foul of Baidu, WeChat, or Alibaba, and therefore making sure that they make their payments. I can imagine that could help replace loan sharks in the future, and replace the aggressive loan retrieval processes that we see too, because I think people will be motivated to repay their loans because they don't want to not be able to access Facebook anymore, for example. So hopefully technology will I think, help answer some of your concerns too.
Cool. We have about 10 minutes left. I would like to conclude these sessions by throwing the last questions if you don't have any further questions from the audience. We'd like to have 4 of you paint out what you think. We have talked about in the past and movement of fintech leaded us today. Now I want you to paint the future, look into the future. What will be the next wave in fintech or digital finance or in the information industries that we're going to see in our lifetime? We're not going to die before that. See in our lifetime.
One thing we haven't talked about is money.
Yes.
Whether that's so-called fiat currency continue to be the kind of money that we will use. In a way, I think the biggest potential existential question to banks is, will money change form? If money changes form, can banks survive? Or do they have to be morphed into something entirely different? We're already seeing a lot of digital money.
A lot of countries make it legal, like Japan, one of those.
Yeah, there's digital money and then there's cryptocurrency. But the very fact that people are becoming used to not using cash, I think is a psychological or important mental first step towards them using some other kind of money altogether rather than just buying dollar. And once that takes place, and it needs to obviously first of all be more efficient, easier to keep, and less costly to move around. All of this can be achieved with technology. So you have to imagine that in one form or another, the digital money will increasingly take up the space of existing currencies. If that's the case, then I think the banking model will change. We have talked about the major roles of banks, wealth management, safekeeping, payments, transfer. We don't need a bank for almost any of that if you're using digital money. And so I guess that's the biggest question we face today. When will I be able to buy my Waterloo with digital money in a way that is as common as it is today to be using normal currency?
So wonderful. Digital money, cryptocurrency is the number one that you should watch out for. Melanie?
For me, it's customer experience, which is something also I don't think we touched on too much today, and the role of the consumer truly being in the driver's seat. I think the consumer being in control of their data, when their data is used, who gets to see it, what they get to see. I think there's transformation coming there. I think there's been a lot of discussion about it. But I think that is going to be one of the big changes that come in the next 12 to 18 months, not 36 to 48 months from now. I think also, we think back to the presentation this morning, the kind of Shika user customer experience. I think that's soon going to become ubiquitous. I mean, that is kind of what is going to be expected, and I think what will be a question and what is still to be seen is what's next, right? What's the next evolution of that customer experience? And as we think about our own processes, what fundamental changes have to take place in order to continue to kind of meet and exceed the expectations of the customer while allowing them to be fully in control of their customer information.
Customer experience. Mr. Thakon.
Before I talk about the next wave of the fintechs, perhaps I look into the banking first. What would be the next wave of the banks and how would we change ourselves? I think there's actually two areas that the bank have to do. One is just similar to Melanie just talking about, improve customer experience. The other one is improve productivity and efficiency. And to gain these two things, you have to have the financial innovation and plus make use of your data. And these two is actually open for fintechs or startup to come in and help us because we do not have the financial innovation the fintech have. The speed of the execution can help us leapfrog or transform ourselves to compete with the other one quicker than that one. But to wrap up my take on the next wave of the fintech, I just came back from Japan and met with one of the largest corporate venture caps. And they says, oh, we're going to open the new fund, join us. Our fund will focus on two things, AI, blockchain. That's it, period. That's the new wave.
Okay, so, and this is not my phrase, but I love it. Where we are headed is the internet of value. So just like we have an internet for information, right now we have systems not just for moving money around, but for all sorts of value transfers that are very old, very inefficient, and prejudicial against the little person. But we have the technology now between blockchain and others. We can disintermediate, we can go peer-to-peer, and we can price independent of scale. So we'll not only be able to move money faster, more accurately, we'll be able to move all sorts of things. We'll take trade and supply chain finance that's still 14th century paper-based technology and bring it into the 21st century. And all of it is possible with seeds that are already in the ground. But it requires the institutional coordination that's going to be the hard part.
All right, cryptocurrency, customer experience, the future of the bank, how you engage with startup, get innovations from the outside to the inside, and also the internet of values and how we do all this supply chain all together. So ladies and gentlemen, thank you so much for joining us. Give them the big round of applause.
Thank you very much.